Good afternoon, everyone, and thank you so much for joining our webinar on AEC, Owning the Change. I'm Tim Showers. I'm an Assurance Director here at McKonly Asbury, and I'm joined today by Dan Sturm, Assurance Partner, and Jeremy Peachey, Tax Partner. We're also very excited to be joined later in the hour by Deepak and Paul of Tellen AI, and we're going to be having a great discussion of the current landscape of AI with them. So we really appreciate them joining us. A little background on us as a firm. So we are based in central Pennsylvania, and we are pleased to offer a variety of services to our clients to help them, which you see listed there. And among those services that we like to do is we strive for our network to be as informed as possible on what's happening out there. So many ways we do that, but a couple of them. One is webinars like this. So this webinar is part of a monthly series that we do throughout the year. And then another way that we strive to do that is through our thought leadership. So we have monthly newsletters for our different service lines, including AEC. So if that's something that you're interested in seeing, hearing from us throughout the year on various topics of what's going on, feel free to scan the QR code there, and that'll open up that and enable you to just subscribe to whatever you may be interested there. So as we open up things up this afternoon, just a little background on the inspiration for this webinar. So owning the change, what do we mean by that? So it's no secret that things are changing rapidly out there, and to the point where it might have been easier to talk about what's not changing as compared to what is. So on the good news front, in terms of major accounting pronouncements, if this were a webinar exclusively about that, there wouldn't be much to discuss, and we'd be sending you on your way here pretty quickly. So that's the good news there. No major accounting pronouncements, but on the flip side of things, there's certainly plenty of things that are changing that'll keep us busy. So owning the change is basically about getting into a mindset and asking ourselves, what would happen if we as organizations looked at the landscape and treated these changes as opportunities to get in front of, make the best of, and really in the midst of them, not just survive and adapt, but thrive by getting to the point where change management was a source of competitive advantage for us as organizations. So that's the common thread that will tie our different topics that we're discussing together this afternoon together. And so we're going to take a few in particular throughout our time today. One source of change certainly is on the inflation and interest rate front. So we're going to talk about cash flow strategies, employee retention strategies, and overhead rate strategies. So Dan and I will cover that. Then we're going to hear from Jeremy to talk about some tax planning strategies. There's a lot changing in the tax world with the recent passage of that legislation. And then for the remainder of the hour, like I said, we're going to be very excited to be joined by Deepak and Paul to talk AI and what that landscape looks like. But first, there's something else very, very important that's at stake for this hour for some of us on the call, and that's the matter of CPE. So 12/31 is a reporting period for CPA, and we want to do our best to make sure you walk out of this hour one step closer to meeting that. So throughout the hour, there will be 4 polling questions that pop up. We'll introduce them as they come, and it'll be important if you're interested in CPE to ensure that you've responded to each of those 4. We'll keep the polling questions up for about 30 to 40 seconds to make sure everyone has time to respond. And that's the idea there. So as long as you respond to the polling questions, you'll be in great shape. As far as CPE goes, our team is good about getting those certificates out to those who are in the CPE within 3 to 4 weeks at least. So certainly before the reporting period would end, you should have that certificate in hand to track and submit as you need. All right, we've got a lot of our audience here is very much interested in that. So those 4 polling questions will be important. A little before we dive into discussing interest rate and cash flow strategies, just a quick disclaimer We'll be talking about interest rate forecasting and making some assumptions. I am, of course, a CPA. I'm not an economics professor. So I'll be talking in the context of here's what the consensus is from those who are economists, and as given that, how should we respond as finance and accounting professionals? So interest rates, very much a hot topic here in the economy. Just helpful to take a look back at where we've come over the last year. So there's definitely been an emphasis on reducing interest rates from the Federal Reserve top down, and we can see how that's had some impact on some of the most important interest rates. And looking ahead in the midst of this environment, forecasts can differ a little bit among the experts, but if you look at what's out there in terms of predictions over the next year, it's looking like we can expect a 0.5 point to a point of additional interest rate cuts as it stands now. So with that environment being as such, from a strategic standpoint, would just encourage our organizations to be thinking about, okay, if interest rates at the very least stay the same or will decline in some meaningful way over the next year, what opportunities are out there for us to own that change? So, you know, is there an opportunity to lock in interest or locking in those higher rates on the investment side and bonds and certificates, money markets? Are we putting our overbillings to the best use that we can? And if we're in a borrowing position, if it's likely that interest rates are going to be lower a year from now than there are, is there anything we can do strategically in terms of timing our major capital expenditures in light of that? Will there be an opportunity to refinance some of our higher rate debt here in about a year? So regardless of what does happen with interest rates, here's a few additional reminders in terms of cash flow strategies that are good in all seasons, whether it's high interest rate environment, low interest rate environment. These principles will apply regardless. And so just to point out a couple of them, can never discount the importance and value that having a reliable, dynamic 12-month cash flow forecast can do. You know, regardless of the cash position you're in, borrowing position, if you're a company that has robust reserves, the good news is by being intentional about, you know, billing, getting into a strong overbilled position, the benefits that can result from that can be very significant and can add up over time, particularly if you layer in some sort of laddering strategy that will enable you to not only have the liquidity to meet the needs as they come on the outflow side, so that good mix of liquidity while experiencing some additional savings in the interest side. And then one of the most fundamental things we've listed there in terms of cash flow is just safeguarding the cash you have. So if you're not currently involved in an intra-fi network arrangement, just encourage you to look into that because that enables you to experience the value of FDIC coverage, even if you do have cash reserves that are above what's protected as a baseline.
Hey, Tim, can you just describe what that intra-fi network is at a high level?
Yeah, so in an intra-fi network, what that does essentially is, let's say that you do business with one bank and you have more, rather than just having just the up to 250,000 in cash reserves. Let's say you happen to have $1 million in cash reserves with that one bank. What that does is, if you then connect to an intra-fi network arrangement with your bank, that bank will disperse whatever is in excess of that 250K out to other banks, so that with no other bank, no single bank are you in excess of the $250,000 FDIC limit. So it enables you to reap the benefits of an FDIC coverage without the worry if there's some sort of bank failure that happens somewhere. You can have that comfort that you're covered, that assurance that you're covered. So basically it spreads out your balance so that with no individual bank, and it's essentially like a sweep, with no individual bank are you in excess of what is covered by the FDIC. Right, so those are some items on the cash flow side. On the employee retention side, certainly there's a lot of mixed signals in the labor market right now, depending on what area of the market you're looking at. But one thing is constant in the midst of that as we plan as organizations, in that we want to keep our key people through challenging times, really good times. And so one of the most significant tools in that strategic regimen right now is the use of deferred compensation plans. So important to note the role that we as accounting and finance professionals can have in helping our organizations plan for that. And one of the biggest is just being mindful, ways that we can do that is being mindful of the potential impact that can have on us as organizations on the financial statements. So just keep in mind that there's a wide breadth of impact that a deferred compensation arrangement can have on your financials. And a lot of times, long before the cash goes out the door, these arrangements can begin to generate expenses and liabilities. So just for the sake of example, we have an illustration here where we have an arrangement for some of our key employees. Oftentimes it can look like this, where they'll earn the benefit over 5 years or so, but they perhaps won't get paid until maybe eight to 10 years from now. And you can see as they're employed, as they're earning that benefit, that liability is actively impacting our balance sheet. The expense is running through our income statement, and it's essentially building. And then finally, in years 8 through 10, the cash goes out the door, the liability is relieved. So just some important things to keep in mind. Accounting and finance can be an active part of that conversation, especially in terms of making sure that finance and HR are aligned in the goals that you're trying to accomplish, because there's important goals, valid goals for the company that may exist across the spectrum, but making sure that you're aligned in what you're looking to accomplish and pairing that with a complete vision of how that will impact the company's financials through modeling it out can really help you as a company strike a good balance so there's no surprises down the road as you proceed with those arrangements. That brings us to our second polling question as we prepare to transition this over to Dan to talk about overhead rates. Really curious as to what everyone's opinion is of my fashion that we saw in the previous slide, and in particular, the nature of that particular photo. So I'm curious as to how the responses play out here. Any predictions, Dan? And what would you vote if you were taking this poll?
I would absolutely vote yes on this one.
So Dan votes yes, and we'll see how things come in as a whole. Okay, all right. We got a pretty split audience here in terms of their believability. I'll just leave it open to interpretation for purposes of the discussion.
Perfect. Thank you, Tim. No, great presentation on deferred comp. I think deferred comp also comes into play as we get in here and talk about FAR overhead rates and things like that. So one other consideration is, as you're evaluating those deferred compensation plans, if you do have an overhead rate that you're getting compensation for revenue from, make sure you're factoring that in as well. Not part of this presentation, but I thought a nice tie-in. From a FAR perspective, I don't think we have a lot of new topics here, but it is November, and I think there's a lot of opportunity for planning. And so what we did for the next few minutes, what we want to present to you is maybe some of the more common things we see and talk about with our clients. Opportunities to increase that overhead rate, at the same time reduce the disallowances. So there's some low-hanging fruit. There's some things that get more complex, but all things that all organizations that are driving revenue from an overhead rate should consider. So first couple of things we want to point out: documentation. That is by far the biggest piece. So when you have an overhead rate, particularly if you have an audit of that overhead rate, make sure you maintain documentation and good documentation. My opinion, there's really not too much that you can maintain when it comes to an overhead rate, because you never know what state or who's going to ask for that documentation. Could be a $25 receipt, something not significant, but good processes, good documentation and maintenance of that information really helps. Also scrutinize high risk accounts. When I say high risk, I think of things like executive compensation, making sure you're in the weeds with that, talking to your auditor, talking to your CPA, things like meals, auto, bonuses, deferred comp, as we just talked about, marketing, all those accounts. This is a great time of year. If you haven't already scrutinized those expenses, make sure you're scrutinizing them now. You don't want to surprise in April or May when you're pulling together your overhead rate to submit to various states. Last point, just be proactive with it. If you have costs that may be unique in the current year, just understand what might be allowable and not allowable. Like I said, the last thing you want is a surprise in a few months that your overhead rate drops maybe more than a couple percent as you might expect. Next item, just optimize your chart of accounts. This honestly is one of the easiest things an organization can do. It sounds very basic, and it is basic, and it's really just making sure that you can easily separate out all of your costs, both direct, indirect, your allowables, your unallowables. Oftentimes we see, especially in a growing organization, we'll see one, I'll use meals, we'll see one example or one line item for meals. Break that out into allowable and unallowable. It just makes life so much easier at the end of the year, the beginning of the year, when you're trying to calculate your overhead rate. So it also allows you to make sure you have a right supporting documentation, back to the first slide, with some of those accounts. Executive compensation. This is probably the top topic that we have conversations with, particularly as state auditors come in and look at overhead rates. Gets a lot of attention. It is disclosed in the financial statements. A couple different options, and I don't think a lot of firms or all firms know this is out there, but there's a common free tool that's available on the AASHTO website to look at allowable executive compensation. It's a great tool. It works. It's free. However, if you're in a very highly compensated market such as New York or California, you may be losing some unallowable executive compensation that you could possibly, under FAR guidance, submit in your overhead rate. How you do that is you can actually pay to have surveys done if you're in a high compensated market. Again, I go back to New York and California because we see that the most often. You can actually pay to have surveys, multiple surveys done to get more granular and actually allow more compensation. So if you're in those markets, or if you have a lot of unallowable compensation from the executive compensation matrix free tool, I would absolutely recommend looking into some survey options. There's paid surveys out there from national providers. If you'd like to talk more about it with us, we also have other resources in the industry that actually compile a lot of data and will do a lot of the heavy lifting for you. So it's a great option. It's not free, but oftentimes it results in a significant addition to allowable costs, increasing your overhead rate. Next item, marketing and bid and proposal. A lot of times we see marketing all thrown in one bucket. There's an opportunity if your marketing team is helping with bid and proposals and putting things together. If you separate that out, there's an opportunity to increase some allowable cost versus putting everything in one bucket and then really not having the data after the fact to go back and separate it. So knowing it up front, and again, we're happy to talk through this in more detail with you if you would like. But separating that out and having separate time codes and separate expense codes to break these costs out could provide some additional allowable costs and increase your overhead rate. The last piece, I think one of the most common things we see is meals and receipts. The support just doesn't exist, or there's credit card slips, there's no itemized receipts. it's across the board. And oftentimes a lot of organizations, particularly larger organizations, will just take the approach, hey, I'm not going to go through all the effort to figure that out or go find old receipts. So I'm just going to disallow, call it 50% of our account. It may not be significant, but over time that could add up. And so I think what we've seen, especially in recent years, there are tools to help you get better with the meal receipt. And this isn't really just for overhead. This is across the board. There's some great products out there. There's some examples at the bottom. I will say I've not used all these products. It's just products as we were putting together this presentation, just the wide variety of options you may have. I have seen a demo of Ramp. I haven't used it personally. I just saw a demo of it, but it makes life simple. You charge something on your credit card, you go to lunch, all of a sudden a text pops up, click the text, take a picture of the receipt, it grabs the information off the receipt, it then submits back through your approval process, and depending on your accounting system, it will file the receipt away, it'll file the itemization away, it'll store the approval, make sure it gets routed through your organization, and then goes into your accounting system. So it takes a lot of the things that aren't happening in a very manual process and automates it. So there are tools I think it's worth looking into, and I'm sure there's probably 10 other tools that I didn't see. But that, again, may not be significant in any one year, but if it affects your overhead rate over a period of time, it could be some extra revenue back in the organization. So with that, I know there's a quick overview. We could probably spend another couple hours just talking about opportunities for overhead rates, but I know everyone wants to hear about tax from Jeremy, so I will cut it off.
Hey, thanks, Dan. Appreciate that. So yeah, we want to talk about some of the tax law changes that particularly impact our AEC industry from the recent tax bill that was passed in July. And so the biggest item that we've been waiting for in the tax industry, if you will, the practice industry, is Section 174, or R&D, research and experimental costs. So beginning in 2022, just as a quick history lesson, taxpayers were required to capitalize all of their research and development costs and then amortize them over 5 years. And what that did was there was a disconnect between when the cash was paid for an expense and when we could take the tax deduction. And so it created some unwanted tax bills, we'll say, in the last several tax years. But with our tax law that was passed here just in July, that changed the recognition of those expenses back to how it was pre-2022. And so now we're able to expense those items in the current period. And so that's going to benefit taxable income, the amounts of tax that companies and taxpayers will have to pay for 2025 and going forward. The other really nice thing that the bill did was, for the costs that had been capitalized and not yet expensed in the amortization process for the last 3 years, we're able to potentially write all those off in the current period in 2025 as well. And so that is going to, significantly reduce taxable income for some taxpayers. So it's one of those items you want to sit down with your CPAs, the folks that are helping you with your tax return filings, and just understand if you have these unamortized costs, what the impact for your tax projections are for the rest of this year and going into 2026. I'll mention too that the research and experimental costs, there's an option to deduct those unamortized costs ratably over 2025 and 2026. So that may be advantageous to certain taxpayers. There is also an option to continue as is. You can continue capitalizing and amortizing the costs as currently if you want to make that election. But it's good news for us in the tax industry, because we've been waiting for this change for a number of years, and so it's going to really benefit a lot of taxpayers. Just to point out too, if you do have foreign costs that are research related, those will remain to be amortized over 15 years. Another key change from the tax bill is the limitation on business interest. So what happened was in 2021, the base for how we calculated how much interest expense we could deduct was changed, and depreciation and amortization expenses were removed from that base, which decreased the amount of interest expense we could deduct. But beginning here in 2025, again, depreciation and amortization expenses are now back into our adjusted taxable income. So we're going to be able to have a larger base to calculate our interest expense deduction, which will, again, benefit most taxpayers in that they'll be able to deduct more interest than they otherwise would have been able to deduct. Bonus depreciation. This is the oldie but goodie. Bonus depreciation history, has been in place in some manner since 2001. And prior to the law that was passed here in July, the current bonus depreciation regime was that only 40% of any asset placed in service in 2025 could be written off in an accelerated manner. However, beginning in January 19th of 2025 of this year, 100% bonus depreciation is back in play. So that means if you acquired property after January 19th, you'll be able to write off 100% of that cost from a tax standpoint, and then additional, reduce your taxable income. A key note for that date is pretty important, because if you acquired property before that date, it continues under the 40% allowable deduction. And another key point is if you are newly constructing an asset, so you're building something new, brand new, there is a caveat that if 10% of the cost was incurred prior to the January 19th date, then that asset most likely would not be eligible for the bonus, the 100% bonus. But it's something that again, we should sit down and look at, have a conversation with your accountants to understand what is deductible, what qualifies for the 100%, and what does not. The limits for 179, Section 179 depreciation, which is another accelerated depreciation available to taxpayers, those maximums were increased to $2.5 million, and then the phase out as well. So that can be another powerful deduction tool that you could use instead of bonus depreciation. And really the difference between these two items is bonus depreciation will allow you to create a tax loss for the year. Section 179 will not. You're limited to taxable income. So you cannot use Section 179 to go below zero, if you will, of taxable income. The other key point is, for taxpayers that are multi-state, you'll want to look at the state impacts of either bonus or Section 179. Each state is very different in how they approach this and what they allow and what they don't allow. So we want to look at our global tax rates to see which depreciation method would be most advantageous, whether it's bonus or Section 179. So just to highlight a couple other quick items that touched on the new tax law. So there were credits. One thing that was not in the tax law was the work opportunity tax credit. This is a credit that historically is looked at the end of each year and typically has been extended year to year. Just a note that this credit has not been extended yet. So it is set to expire as of December 31st of 2025. So we'll look to see whether that's extended here in the next six weeks or so. Another point, energy credits. There were a lot of energy credits that have been in place in the last 3 to 4 years. And just a kind of a broad note that effectively most of those energy credits that are currently in place will be repealed, either already have been repealed or in some fashion will be phased out through 2027. So you'll want to check into, if you have projects in line that you are expecting credits, you'll just want to make sure that those credits are going to still be available to you. Section 179D was a special accelerated expense that was put into place for energy efficient property. Again, it's going to be phased out effective June 30th of 2026. So again, if you have projects in place that would currently qualify for that, they'll still qualify, but any new projects started after June 30th will not. Another interesting one, this is for small residential contractor relief. So the current rules on how we treat our income from a tax perspective is we have to use percentage of completion for most contracts. However, they changed the rules of a definition that residential construction contracts projects now will include skilled nursing facilities, apartment buildings, dormitories, and student housing. So they've expanded the definition of what qualifies. So there might be a potential for some deferral of income for certain construction folks that did not exist prior to this tax law. So again, it's one of those things, if you're in those markets and constructing those types of residential properties, you might want to sit down with your tax folks and see if you qualify for this additional deferral. And just lastly, just some notes on some of the changes in filing compliance requirements. 1099 filing. So currently, most of us, we've been in this threshold of $600. We have to issue 1099s for any subcontractor or professional service provider of $600 or more in payments. That threshold will be increased to $2,000 effective in 2026. And then that $2,000 threshold will be indexed for inflation. So it'll change nominally each year. So it's, again, just a way to ease the burden on some of the smaller vendors that we might have to currently issue 1099s for. Just one of the new things that was added to the law, and from an employer perspective, so there is an exemption for individuals who receive overtime pay. And so just a note, the exemption is only for the half and the half time of the overtime pay. So it's only the incremental difference that an employer has to pay to an employee for that extra over 40 hours in a week. Interestingly, for W-2 filing, for 2025, there is no requirement for this information to be reported. They're not changing W-2 forms. But most employers are required to issue some type of attachment or statement that indicates how much overtime pay would qualify for their employees. However, just about a week and a half ago, the IRS issued a notice saying that there will be relief in 2025 if employers do not issue that statement for the overtime compensation differential, so that there is some relief. But starting in 2026, there will be a new code. I believe it's under box 12. There'll be a new code to report this incremental half time for the overtime pay. So just be on the lookout for changes in your payroll systems.
Okay, thank you, Jeremy, for providing the tax update. If Jeremy piqued anybody's interest with anything that he mentioned there, we just encourage everyone to consider checking out our next webinar in the McKonly and Asbury series, which is coming out on December 11th, where the team will be delving for the full hour of that webinar into the new tax bill and the different nuances there. So just encourage everyone to think about that one, December 11th. So with this next poll, we never shy away from covering the hard-hitting topics here at McKonly and Asbury, whatever the category might be. So this one's asking you who you think Penn State's next football coach will be. We certainly have some strong contenders there listed, and the three that we've mentioned, but certainly feel free to type in the comments section if you have other thoughts beyond what's listed.
I guess, Tim, Sherlock Showers isn't going to be on that list, huh?
No, he didn't make the cut this time, Jeremy. Wow. Okay. Very strong contender coming in there, and Brett Bauer. So I would tend to agree with that, but we'll see what happens. Well, at this point in the webinar, we're very excited to welcome Deepak and Paul into the conversation. As Deepak prepares to share his screen to bring up a couple of things with the group here. We've been working with Tellen AI to help us integrate some AI into our daily operations. And in addition to really knowing their stuff, they both happen to be great guys. So we really appreciate them joining us. And as we prepare to kick things off here, Deepak, if you wouldn't mind just starting out with telling us a little bit about yourselves and what you do at Tellen.
Yeah, thank you so much. Thanks, Tim, for having us. It's been a pleasure working with McKonly and Asbury over the last several months. And thanks again for giving us this opportunity to talk to everyone a little bit about agentic AI. So a little bit about myself. I'm Deepak. I'm the CEO and one of the founders of Tellen. My background is also in audit and assurance. I was with Ernst & Young for many years before moving to the industry and working as a CFO for mostly financial services firms. So I'll hand it over to Paul for a very brief intro, and then I'd love to run you guys through a few slides on what is agentic AI.
Hey folks, my name's Paul Gerlich. I'm the head of engineering at Tellen. Before this, I worked both at Workiva and Audit Board, building out their internal audit solutions. Been with Tellen for a little over 8 months now, building out their V2 platform. I'm excited to talk to you all about agentic AI and what it means for you all in your day-to-day.
Awesome. So yeah, just to start with, we want to spend just a couple of minutes explaining what is agentic AI. Agentic AI is really the hot word of 2025, and it is the natural evolution of generative AI, which we were all introduced to several years ago. So I'll be very quick with this presentation, and we actually have a practical example later on. So let's start with what is a large language model. So large language model essentially is a program that is trained on huge amounts of text. It learns how the words and ideas follow each other. And when you give it a sentence, it predicts the next word. So essentially you can think of it as a black box, which has been trained on all the text that is available on the internet. And it's a prediction engine, which essentially predicts the next word. So that's a large language model in its raw form. What we have been able to do with large language models is build chatbots on top of them. So while this is a model that predicts the next word, you can build applications like a chatbot, which makes it conversational and generative. So you can actually ask it a question and it will answer the question. So basically, a chatbot is an interface that's built on top of an LLM. It takes your message, sends it to the LLM, and the chatbot then shows the reply that the LLM gave it. And then it has a little bit of a short-term memory, so you can actually have a conversation of sorts with using a chatbot. So then agentic AI, which is what we're introducing now and what has been kind of in the works over the last several months now, it's another type of an application that's built on top of a large language model, but rather than just being a chatbot, which is a conversational application, this is a application that can actually achieve a goal or an objective, and it can also utilize tools like reading a file or using a calculator or creating a calculation, and it can also have that memory and remember what it has done before, and it can also have autonomy in how to use those tools to meet the user's objective. So this might become a little bit more clear as we show examples later on, but essentially you can think of agents as applications that are built on top large language models, and then agents have autonomy on how they solve a particular problem, and they can use tools to solve those problems. Okay, yeah, with that, I'll hand it back to you, Tim, for, I believe you have some questions that we wanted to run through.
Yeah, thank you, Deepak, and thank you for providing some very helpful clarity. I know there's a lot of buzzwords we hear thrown around all the time, so the more that we can hear from context from the experts, particularly as it pertains to the real key evolution of AI is moving from generative to agentic. It's very helpful as we think about how we can begin to or continue to apply AI to our daily lives and our professional lives as well. So as we dig into the conversation here then, guys, one of the things, certainly in terms of the upside of AI, the promise of AI and what it could potentially do is take care of some of the menial tasks, in our day-to-day lives and really free us up for the things that matter most. So one of the questions I had for you guys, as experts, you guys live and breathe this every day. Could you guys give us some examples of the types of things that you guys are using AI for in your day-to-day lives to free you up for what really matters?
Yeah, I'm happy to take that on first, and then I'll hand it over to Paul. I would say we, as professionals, we all are using AI to some extent or the other. But I would say the biggest impact of AI has actually been on startups. So startups are in the business of, discovering a brand new business opportunity, creating a business model around that. And a startup by definition is a brand new business. So it has to build all the business processes and controls and various functions. So we use AI almost every single day. All of our employees have access, subscriptions to ChatGPT and Claude and other AI tools. And personally, I can give you my perspective. I use AI for whenever there is any writing that I have to do that's longer than half a page. So sometimes emails I would draft obviously manually, but if there is a really long content piece that I have to write, like a blog or a report that I have to write, or even actually create like policies for our companies that we're establishing, creating a vision document or a culture document that I might be creating as a CEO, I almost always go back to ChatGPT for that sort of thing. So I would think of it as anything which involves writing and more than half a page in length. I almost always revert to ChatGPT and give it some bullet points, and it kind of converts it to something like a written text. But I'll hand it over to Paul because I believe he will have a very different perspective. It's the role of AI in engineering is a lot more nuanced. So over to you, Paul.
Yeah, I have a more I'm in the fortunate and unfortunate position that my job is the first one that everybody's trying to automate. It's a bunch of software engineers building all of the AI, and they're like, well, let's make our lives easier. So that's both a little overwhelming and terrifying, but also really exciting for me, especially being the head of engineering at Tellen. We have a very small team that gets a tremendous amount of work done because my entire job is automated by AI now. I do not write code anymore, which is pretty crazy because it used to be that when I was writing code as an individual contributor, it's 8 hours a day. I'm in the code, writing the code, but now it's 0%. Maybe once every week or two, I have to go in and tweak the code a little bit, but it's basically like having a conversation with the team. I'll have 5 or 7 very large features going on at the same time and having conversations with AI to move the needle there and give it feedback. And so I would say it's pretty much the majority of what I do now is just talk to AI all the time, which is exciting, but also it's different for sure. And I think that it's a mindset shift, but it's not as scary as people like to think it is either. It's really, I really do feel that level of elevation up to a higher kind of leverage position there as even performing IC roles. I'm now more like managing a team of engineers, but those engineers are AI. So I think in the folks on our team as well that are engineers, and that's their day job, is they're not managing people or anything, just working in the code, are also managing a team of AI engineers. So it's different, but it's exciting.
Great. We really appreciate you both sharing some thoughts on how day-to-day life is AI is helping making your lives a little easier. Let's fine-tune the conversation a little bit now and focus specifically on the world of accounting and finance. I know a lot of people in our industry are looking at the potential of AI and really thinking about, okay, this is very, very interesting development. How can we begin to use it in a practical way to help our teams out on the financial and accounting side? So I believe, Deepak, at this point, we have a really good use case that you'd like to demo at this point that could be very applicable to AEC and the world of contract review.
Yes, I would be happy to do that. So I believe my screen's already shared. I just want to run you through something very basic before something in these slides before I show you that, which is, as we all know, as we were earlier introduced to the concept of AI, we all learned about prompt engineering. And prompt engineering, in simple words, is basically just structuring the question that you ask the AI in the right way and really giving those instructions to the the chatbot so it can give you a return. And with agentic AI, it gets a little bit more nuanced, which is the prompt engineering is kind of evolved into this bigger field called context engineering, which is that agents now can take multiple documents, they can use multiple tools, and they can have autonomy on how they answer question. So the availability, so as a user, what we need to think really detailed about is what are the documents that'll be used and what are the tools that the agents is going to use, and and then what will be the prompt that we give it for it to achieve that objective. So what I want to show you here is a practical demonstration of how we can create an agent and how that agent can help us solve a particular problem in and a use case in a day-to-day world. So Tim, thanks for working with me to kind of think of a use case that'll be relevant for this audience. So Tim and I discussed earlier that we could build an agent which could help us with reviewing contracts, specifically construction contracts. So I'm gonna show you how we actually create an agent using the platform that we have built. But obviously there's multiple tools available that can help you create agentic applications like this. So I'm gonna go here. I'm gonna take this prompt that we had written, and I'm gonna create a new agent. So I went into create a new agent, and I'm adding this prompt here, which is assist construction finance professionals to extract contract value, scope, liquidated damages, and indemnification from uploaded contract. So this is the only instruction that I'm providing it. And we actually have a feature here that allows you to then build an agent. So the button that I clicked helped me create this agent, which is called Contract Value Extractor Pro. And then it has several things that it's already automatically pre-populated, which is it's given it a name called the Construction Finance Contract Analyst. It's given a primary goal, which is to extract contract value, scope, liquidated damages, and indemnification. And then it's given a process and reasoning steps. So it will follow these various steps as it returns the answer to us, including normalizing the values and returning in a structured way, documenting any gaps, and highlighting within the contract all the right places from where it actually sources the data. Okay, so I have created this agent. I will now save this agent, and I can run this agent now. So I'm actually gonna, so this is a contract insights agent that I just created. I'm actually gonna run this agent, which is almost the exact same agent that that we created earlier, just because it already has all the right documents. So then I will upload a sample document, which can be a construction contract that we created for demonstration purposes. So this agent now within its memory has within its current conversation files has the the document. It is showing me a chat window where I can interact with the agent, and I can ask it a very specific question like, extract all this information from the uploaded documents. So what the agent is running through now is kind of it's the steps that it needs to achieve that objective. So I've given it an objective, which is I want you to extract all this, and it's scanning all the available files. So it's telling me that it's looking at the file. It then is telling me that it's found 4 results in that file. It's doing its thinking, and now it's actually doing on the work. So it's actually doing the work where it has extracted those 4 items that it's asked for: the contract value, the scope, the liquidated damages, and the indemnification. And along with extracting all this information, it's actually showing me where in the document it's being extracted from. So it's saying 428,500 lump sum for full performance of the work, and it's giving me a reference here, and I can click on the reference. And one of the tools that it actually uses, this agent uses, is this tool that we have built, which is called an annotation tool. So this will highlight in the contract the clause from where we derive the value, so you as a user can quickly verify that. So I have the number here, and I can quickly click here to validate that this number is extracted from, page 2 of the contract and clause 4.1. I have the scope here, which is a full interior renovation, which is demolition of 1,200 square feet, and I can click 2 here to navigate to the right places, which has the scope of work and liquidated damages and so on. So this is a simple kind of demonstration of us creating an agent, which is a very specific agent, which extracts these data points from the contract, and it uses the tools like the annotation tools to highlight from the right places within the contract. Okay, yeah, so hopefully that was helpful. Happy to go into more detail later on if that's helpful.
Yeah, appreciate you walking us through that, Deepak. And at a more fundamental level, one of the things that I was also impressed with as we were going through this potential use case is how at the very beginning, the AI can earmark the document, categorize the document into a table of contents in a very orderly and meaningful way. So it's readily apparent how helpful this technology can be for something like this in terms of contract review. At the very least, if not giving us a word for word what we need, at least pointing us in the right direction to streamline our review whenever we open up a contract and seek to, boil it down to its essence in terms of the most critical terms.
Yeah, absolutely. And I think this is what you're referring to, Tim. One of the things that the tool does is extract and create a table of contents. So it really goes through the contract and breaks it down into a table of contents, which is then used by the agent to understand where it needs to go to extract all the relevant data.
Excellent. Great. As we look to wrap up our time together, guys, and squeeze in the very last poll question here, I do have one more question I would appreciate your guys' thoughts on, your advice on. As we look ahead, we want to make this coming year successful in our careers, the next few years successful, many years and successful in our careers. In your opinion, what are some practical steps that financial professionals can take today that will prepare them for success in the accounting world of tomorrow in light of the emergence of AI? Thank you guys for that demonstration. We can just move to the last polling question at this point then, if we want to go ahead and launch that. And yes. Just a forward-thinking thought here, and that is, to what extent have you integrated AI into your accounting and reporting functions? Right, as we give everyone just a few more seconds here to answer this last polling question here. Let's put a nice wrap on our session together. Make sure everyone gets their CPE credit. Looks like all the answers are in. So thank you again for everyone who joined us today. Thank you again to our presenters, Dan, Jeremy, Paul, and Deepak, so much for joining us. Appreciate all of your time today. And again, in terms of upcoming events here, don't forget to tune in if you can and you're interested in the tax update that we have coming up on December 11th. And then, please feel free, reach out if you have questions on these topics we've covered today or others. I believe everyone who attended the webinar or registered for the webinar has the slide deck, complete slide deck. It has all of our contact information in it, so please feel free to reach out anytime. So again, thank you all for attending today, and I hope you have a good rest of your afternoon. Take care, everybody.